from the Coleman Nation. The great Ron Coleman is joining us. Mr. Coleman, good evening, sir.
Good evening to you, Val. Good evening to you, Pro. Great to see you guys as usual, especially in such a slow week. Hopefully we can call upon our wits to find things to talk about.
Indeed.
Tiddlywinks. That's where I think we're going today.
Not much going on. Nothing at all. Yeah, it's been a wild one. And, it's watching what's going on out there in Hollywood land. And you look at it, just kind of a precursor to this. And we don't need to get into details because this audience is smart. They know where I'm going with this. Look at the state of culture in Hollywood. And then look at the state of culture in current world affairs, current politics. I mean, Ron, is there maybe some kind of connection there?
I think that we are in a situation of general decline and fall in many, many respects. Hopefully not in my 401k or those of yours or any of your clients, but because I'm old enough that I can play this out. but my many descendants and counting, I have to worry about them, and there's much to worry about. Yes, we are existing in a thoroughly debased culture in every sense of the word culture, in terms of political culture, in terms of civic culture, in terms of social relations, and in terms of culture, even popular culture. It's just about never been worse. That's a problem. That's a problem.
Does the market give you some hope, though, Ron? Looking at what we're watching out of folks, are saying no, resoundingly no, they are not going to go watch this drivel. Does that give you any hope?
Yes, it does. Yes, it does. I mean, on the one hand, as you and I were talking about before we went live, there's the market and there's the market. I mean, Disney's number one market is its shareholders. If they can continue to lose big money, and although their stock price has tanked, and I'm sure we'll talk about that, it hasn't tanked nearly as much as one might expect. Although, as you guys have taught me, the studio is only a relatively small part of the picture, but it is a very impactful one in terms of image.
Well, let me give it real quick. Let me insert here, and then I want you to keep going. I hate to interrupt you because you're far smarter than I.
I will. If I have to say, you can be confident you'll eventually come out.
The heart is a very small organ in the body, but I would suggest that you don't want it to stop. And the creative content of Disney probably doesn't need to go on ice. That's my thought.
Well, right. Well, yes, you're really saying what I was going to say, which is that when the Disney brand, and remember, I spent most of my career as a trademark lawyer, the Disney brand is about Snow White. It's about Mickey Mouse, and notwithstanding all the things. And as I shared with you guys a link earlier this week privately to a tweet that I actually couldn't help but share on a YouTube channel that I had, linking to a YouTube channel that I had never seen before, talking about what a wretched experience. It's a travel channel. The host had at a new Disney resort hotel. Yeah. Way overpriced and crummy experience. And it is part, I would think at some point analysts are going to say, what are you doing with the equity in this brand? What are you doing with the heritage that you've been given? It really is hard to understand how long you can go pissing away this kind of brand legacy and not have it reflected in the stock price any more than it already is.
You're totally right, Ron. Here's the thing. There are, and there have been for the last, good Lord, several years, at least I'll say since 2019, since before I got onto YouTube for sure. We're coming up on our 3-year anniversary on February 1st. So just a couple of months away. And and it took me about 6 months to a year to really get into the business side of things with Disney. When I started on YouTube, it was the Gina Carano story had just broken like a week after I started YouTube. So everything was Star Wars, Mando, this and that. And I gravitated into this, but I could tell you I've been watching this for a while as somebody who's worked in the financial industry as an advisor for over 20 years or close to 20 years at this point. The apologists out there for Disney and for the failures are there's a lot of them. I mean, I feel like, and I've felt like for years, there are far more apologists. And when I say apologists, let me stipulate, I'm talking about like Wall Street apologists for Disney. Far more of them out there than I would say most other major companies. And I think, my opinion, I think the reason for that is that they're an entertainment company. They're very high profile. They're dug into the media. They own a lot of media. They have the capacity to put out messaging like most other Dow industrial components can't, or like most other S&P components can't. I mean, it's not like, United Health is also in the Dow Jones. They represent the health insurance sector in the health and medical sector on the Dow Jones 30. But United Health isn't a big entertainment company. I mean, they're bigger than Disney, but they're not an entertainment company. They're not a media company. So I think this is what has largely insulated the Walt Disney Company from proper criticisms that I think, in my opinion, would have befallen any other Dow company or any other S&P company of this magnitude over the last several years had they been in the same boat, or had they been.
Now, I mean, as an investment advisor, as someone whose life is this, and that is what you're talking about. You can't fool all the people all the time.
Right.
The money has to eventually, the columns have to add up.
Right.
I think what we're watching is the battle between the market and institutions.
Yeah.
Do institutions control the success of companies, or do market reactions control? We've seen the market reaction. We've seen declining attendance at the theme parks. We have seen devastating declines in the box office. And we're seeing subscriber counts that are dubious sometimes, but often underperform what they have suggested in the past will be done.
Yeah.
And yet the institutions continue to back what's being done. And I think that's for ideological purposes.
But all right, but at the end of the day, you don't have to sign on completely to the efficient market hypothesis to recognize that that's not sustainable. Someone is going to cheat. Someone, even in the institutional world, whether it's a private equity fund, it might not be BlackRock, but it might be BlackRock. Someone's going to say there's a ridiculous overbuying. This stock is preposterously overbought. And I'm not going to be the last guy to hold it when everyone figures out that it's a scam. Yeah. And once that fire gets lit, or we're missing something very profound, which is entirely possible. I mean, it's impossible. It's possible that Ron Coleman is. I don't think it's possible that you two guys are, because you really spend so much attention on this. I will tell you one thing that did occur to me, though, and I wanted to make sure, because I've been thinking about this for weeks, and I actually wanted to ring you up separately, Valiant, to talk about it. We've both been so busy. When we talk about on these pictures breaking even and making a profit, and I've kind of alluded to this once. I once had a little bit of a back and forth in the comments on one of your videos. You have to remember that breaking even is, you don't get a medal for breaking even in Hollywood. Okay? Right. So I did a little bit of amateur research and learned something that I'm sure you guys both know, which is that the expected ROI on a motion picture is between 110 and 125%. Okay, that means that you get back your money and you collect a premium of 10 to 25% on that money.
At least.
So when you're talking about something like the Marvels, which all in budget, not budget, but actual money spent, right, is probably in 325, fair guess, probably low, right?
I'm going 375.
Okay.
375 minus some tax credits. I did a video today. I put the final net cost of the Marvels at somewhere around, after the tax credits, at 300 million. So I'll talk about that video in a minute. But yeah, you're
And
right.
that's
there.
not including marketing, correct?
Bottom line,
No.
Right.
to really break even from a shareholder point of view, as in, is our money being well spent?
Right.
They need to make a profit of pretty close to 400 million. In other words, break even isn't even really the zero.
Right, because it doesn't even keep pace with inflation.
And this is relevant, by the way, in case they're in the unlikely but nonetheless distinctly possible event that there is a shareholder lawsuit, a derivative lawsuit, and you start taking a look at the business judgment rule, which chancellors tend to be extraordinarily generous with. There's a point where you're losing money so profoundly and falling so far short of what your shareholders' money should be doing for them that this becomes a relevant consideration. So I think we have to, when we talk about break even, we have to remember break even is a purely financial concept.
Yes.
But from a commercial or a business or a shareholder benefit point of view, it's not even close. It's not even close.
There's more things to add into that, and you bring up an excellent point that I didn't even think about going into tonight, but I think you set it up beautifully. We're going to talk about the economic opportunity costs here, because you're right. It's not just about one picture, in this case, the Marvels, being a disaster. This is about an unmitigated chain of disaster for Disney in the past 12 to 18 months, and the pain is not over yet.
And the cascade that flows underneath that as well, because if this fails, and it has, then the merchandise fails, every bit of it underneath. So all the partners who are connected with the merchandise.
What merchandise?
Exactly.
What merchandise?
And that goes back to your opportunity cost that you just mentioned.
Exactly. Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.